I have, family members who are within the age bracket of the 15, 24-year olds, the younger, and they have this sort of mentality, the sort of mindset of, minimalism and less consumerism in general, right? Consuming things. My advice and they want to learn about money, but they don't want to have to manage it either. So I think these set and forget things and the set and forget mentality and let it grow is equally important. So what I told to them personally, and kind of in line with what you're saying in a certain way, it's like open a Roth and go through a certain company, and you don't have and check once a year or so if you want, and forget about it. I mean, does that kind of fall in line with your idea and how you do things?
Yes, it does. The premise of our business, and we're not certainly unique in this way, there's many proponents of this. This all started with John Bogle and Vanguard back in the mid-'70s when he rolled out the first index fund, which is now quite a worldwide phenomenon, is that all you really need to do is to own the markets, represented by what's called an index fund or an index ETF. They're very low cost. And by doing this, you will participate in the growth of the markets. And that's the kind of set and forget or couch potato portfolio. There's different expressions that will describe this kind of investing. The point of it, though, is that it's not complicated. It's relatively actually very simple to do. In fact, companies like Vanguard, Schwab, Fidelity all have excellent low-cost target date funds that people can use. That's why I have all my money in a Vanguard 2045 target date fund. It's an all-in-one fund. It will slowly get more conservative to the point at which I need the funds.
Can you explain that a little bit, Mark? I'm sorry to interrupt you, just for our viewers to know what is that whole concept and idea of investing in a target date fund, and how does it work?
So target date funds, I think Vanguard's target date funds are the world's largest investments. They're used in a lot of different employer-based plans, and I would recommend them really for anybody, for the most part, that has access to those funds, unless they're, people that wouldn't be able to access those, expats or something. A target date fund is a fund where the investments are considered to be invested appropriately based upon your retirement date. Your retirement date is your target date. So if you're 30 and we're using 65 or 67 as the target retirement date, that would be 35 years from now. And so your target date is 2055. So you would invest in the Vanguard target retirement date 2055. That's an choice. Now that fund is at this point about 90% stocks, 10% bonds. It will stay 90% stock, 10% bonds for probably 12 to 15 years. Then it will begin to slowly get more conservative as you age from 45 to 65. So the 90% stocks, 10% bonds, which is classically an aggressive portfolio, by the time you get to your target date, it will be something more like 50-50, 50% stocks, 50% bonds. Now, when you use a target date fund, it doesn't mean you have to retire then or you get to retire then. Your money's not locked up in these funds. It's just a very simple, hands-off, appropriate way to invest. I think they're fantastic.
And I have a question about that, Mark. Is there still enough momentum, let's say, on the latter part of that way of investing to still get decent growth? Because I've heard sometimes some sort of stipulation, it doesn't grow enough, and
Correct.
Towards the end, and I lose out on a lot of maybe a good bull run or something. Would you agree with that or disagree with that?
Well, the longer you have in the market, the more likely you are to make a higher rate of return. So the investor that has 20, 25, 30, 35 years, they're going to participate in more what we call bull runs. And a bull run is when the market goes up. So what happens is, correct, as you get closer to your target date, the portfolio gets more conservative. So you have less likelihood of participating in a higher growth bull run because you have less in the stock market. On the other hand, it's also typically going to be the case that investor doesn't need as much return. And what will become more important for all of these investors at their age of retirement, whether it's 75 or 65 or 60 or 55, is they're going to want more stability. They're willing to trade off growth for stability because they're living off the money.
Sure.
So you do want to reduce the volatility of your portfolio as you get closer to the point in time in which you're taking the money out.